why are rates going lower? I mean, part of the reason could be what we're seeing now, obviously, geopolitically overseas, flight to quality in the form of bond yields. No, without question. I'll say this, and I was talking to Dan earlier today. We play the game. If you had told me last week what would have transpired over the weekend, I would have been horrified. But I would have said, you know what, Mel? Rates are going to be significantly lower in the back of that. Not 4.65% in the 10-year, closer to 4.5. And we're not. So the fact that rates move lower makes sense. The fact that they didn't meaningfully move lower is somewhat problematic, I think, especially when we have some inflation numbers coming out.
And they don't make any sense in the context of the economic data that we've seen. So since Friday morning, when you look at that jobs report, if you look at the CPI that we're looking forward to, it's expected to be 3.6%. I know a lot of us were, thought that we would see that 9% print for, what was it, June or July of 2022 get cut in half at some point. That was going to be transitory. But I guess the story of the data that we're having right now, we spent a lot of time. Last night, we had that great conversation with Bill Simon on the consumer there, and he had actually some trepidation about the consumer. But a lot of the data suggests that those inflationary pressures are sticky. Guy, you were calling it, what, pesky and persistent?
Pesky and persistent.
Yes, that was you last year, and it has proven to be that way. So I just don't know how the Fed can be meaningfully dovish in face of some of the data that we are seeing.
They've been dovish. They've been dovish just yesterday. They were dovish today.
Not all of the Fed. You're talking about Chair Powell.
That's true.
You're talking about Chair Powell.
Well, as an institution, Steve.
No, I get it. I'm helping you on the same side.
Good.
So
it doesn't even sound like you're on the same side.
Exactly. Yeah. When we agree, we disagree. So when you look at rates, though, rates are up 84 basis points from August 1st. That is screaming higher. Those are overdone. So we could say any reason why they're backing off. They're backing off. It's bullish. There's always, when you say recent past, there's always an inverse correlation to rates and the equity market. They've just been so low for so long that we never really realized the correlation was still on. So when you say what's that geopolitical, we're all nervous. Market, earnings, maybe financials are going to have a headwind on them. But I said it on Friday. The 10-year did the lifting for the Fed. They'll never, to your point or Dan's point, whichever I agreed with, they're never going to say they're done. Never. Doesn't behoove them to say they're done because then inflation creeps in again. If inflation creeps in again, inflation has been falling. What's been sticky? Wages have been sticky. Unemployment is low. Wages going up. People have jobs. The market's okay.
They also have a lot of savings. There are a number of banks reacting to revised government data, which shows that there's actually more savings at households than previously anticipated. Citi now saying more than $1 trillion in savings still that consumers have, which would be good for a soft landing.
It would. There seems to be a lot of noise then around where the consumer's balance sheet really is. They're employed, which is good. We are seeing a number of, in the auto space, the auto workers, they're going to have decent, whatever they settle on, ultimately will be decent price hikes, right? But I still think, I've been surprised at how much the market's moved, how quickly. I do think it could all go away with a bad number tomorrow, and particularly Thursday CPI, that will just reverse what we've seen, because I think some of it was we were down so much in such a short amount of time that a bounce back, I don't know if this fits into your Fibonacci or 50% retracement from that down. What?
Fibonacci. It was a great man. We studied together.
Yes. Galileo was in the other class. Yeah.
Advanced class. It's interesting. We had mentioned, I thought 4190 was a logical place. Stephen mentioned that as well. In terms of levels, would find support. We got down to 42.35. To your point, markets rallied almost 4% since those lows we made, I think, sometime last week. What has it rallied on? Certainly not fundamentals. An oversold condition, a lot of people have talked about that. We've worked that off to a certain degree. Fundamentals aren't getting better. And again, yes, rates have backed off a little bit. Rates are still higher, and this re-steepening of the yield curve historically is not really a good thing. We're seeing that all happen right before our eyes. And if Karen's right, if you get a hot number, which, the calendar suggests we will, last month's inflation numbers started to trend higher. I think that will continue. Fed's in a bit of a box here.